immediately in the financial market. Right? Suppose we're trading in the market today. The shares are not delivered to the buyers today. That will happen tomorrow. Right? There's always a short time delay. So this process of delivering the shares and basically withdrawing the money from your bank accounts, that's called settlement. Settlement happens with 1 day of delay. So the thing that you could do is you could go to the stock market in the morning, and maybe right now, or when the market opens. I think it's not open yet. You sell a share, and then in the afternoon you buy it back with the idea of hopefully having a lower price, and then the difference will be your profit. Right? Both of these transactions will be settled tomorrow, so the person that you sell the shares to in the morning doesn't realize that you don't have them. Right? So you're basically using this kind of delay in the settlement. This only works for very, very short time periods. So basically you can only do this within a single day, intraday. This type of short sale is called uncovered short sale, and uncovered because sometimes also it's called naked short sale because you really don't have the thing that you're selling. It is regulated, so it's actually not allowed for some companies. I think you're not allowed to do that with stocks of banks, for example. Was a rule that was introduced during the financial crisis of 2007, 2008, where there were a lot of short sellers in the market. And as it's very often the case in financial markets, people went after the messenger, basically, the person who made it obvious that there was something wrong, so they went for the short sellers as the bad guys, that the investment bankers who actually caused their shares to plummet, they could continue working. Right? So there was a reason why the share prices went down, and short sellers were just basically making that apparent, in my view. But we have lots of regulation around it as a consequence, and we just have to accept that that's the case. So it's highly regulated. As private investors, we actually can hardly do this because our brokers don't allow us to do it. Now, this is the probably more uncommon case of how short selling works. The covered short sale, the second alternative, would be the thing that you see more in practice. So how does that work now? So there's some investors who basically have lots of shares and basically want to hold them for basically forever. So these might be a pension fund who's planning to kind of, or maybe from a corporation, so they're saving money for the retirement of their employees. So investment horizon is like 20 years or so. So what they do is they just buy some shares and let them sit there, right? Now their idea is, can we make a little bit of extra money on the side? So what they do is they lend the shares to someone else, right? So the person who wants to do short selling knocks on the door of like one of these big funds, like Fidelity, for example, or Allianz in Germany, or Deutsche Bank, and asks them, can you borrow me your shares for a month or so? I give you a fee for it. Right? So then the shares are transferred to the borrower, and the borrower now has the actual shares and can sell them in the market. Right? So you sell the shares in the market, and now you have much more time to actually kind of wait until something happens. So of course, again, you would do this only because you hope that the share price is going to fall in the short run. And then at some point, maybe after the month, after the time that you agreed with the person who was lending you the shares, you have to return them to the person, right? So you have to go to the market and buy them back. And because shares are kind of standardized, you don't have to buy exactly the same shares, right? You can go to whatever stock market that you want and just buy the same type of shares and then return them to the investor. Right? So this is much more common. It's still regulated in the sense that you have to publish it when you do short selling. So there are statistics about this. This is the so-called short interest. So it's a number that, for example, in the US, you can look up very easily like how much in percent of the shares are sold through short selling. So it's an information which is usually public. So the second mechanism, the covered short sale, is the more typical one, and that's basically how you can do this kind of transaction for a little bit longer than just within a single day. Okay, so maybe let's have a look at the cash flows coming from these positions first. So let's start off with what are the cash flows if you buy an asset. I mean, this is probably very simple, but let's just kind of repeat this because it might get more complicated later on, and I want to basically tell you how you can quickly derive the cash flows from a short position without too much hassle. So the first thing that I always do is I think about what's the cash flow from a trade if I buy something. If I buy something, I have to pay the price today, right? For example, I want to buy Daimler shares. I get the Daimler shares and I pay the share price, today's share price. In terms of a cash flow, that will be, from my perspective, a cash outflow. So that's usually denoted by a negative number. If I write the cash flows here of a long position, the cash flow will be negative today because I have to make the payment. And then in the future, at this, from today's point of view, unknown share price as capital T, I can sell the share. Right? If I sell the share, I give it away and I get the share price that will realize in the future. So that's a cash inflow, and that is shown by a positive number. So if you buy something, you pay a price today and you get money in the future. Cash outflow today, cash inflow in the future. Right. And now comes the easy part to derive the cash flow of a short position is just take the cash flows of the long position and flip the sign. Right? So make a minus becomes a plus and the plus becomes a minus. Is that the question? Right, so the short position is really just the opposite. You get the share price today, and you have a cash outflow in the future. Right? If you sell something, you get money today. Right? And then in the future, you have to buy it back, so you have a cash outflow. And again, this is an easy example, but we're looking at more complicated products in the future, and it becomes a little bit messy, like what are the cash flows from short positions? So I would recommend to do it, and I've actually written this down here, as what I think is a useful way of thinking, is always just only memorize one stream of cash flows. That's when you buy something. And then, if you want to know what the cash flow of the short position is, just flip the signs. Right? That's, for me, the easiest way to memorize the cash flows coming from products. So let's have a look at this cash flow of the short position again, and suppose put yourselves into the shoes of a person who's kind of lending out their securities to a short seller. Right? What's the cash flow that the short seller has? So the cash flow, the short seller borrows the securities and then sells them and has a cash inflow. So the short seller is now sitting on a lot of cash. And wouldn't be the first time that this happens in financial markets. Question is, what do they do with the cash? They could run away, basically, right? They just made a decent amount of money, so they can just take the money and run to maybe the Cayman Islands, where no one can catch them. Or they can use the money to speculate, so they can do other trades with the money and lose the money, right? So it's a very, very risky thing, because the cash outflow is some point in the future, and the case, or it might well happen that there is not enough money on the side of the short seller to buy back the shares. So that's why there's some kind of security mechanism. So typically there's, you're required to maintain a bank account with a broker, so-called prime broker, who kind of manage everything. And you have to put up basically collateral, right? So you have to make sure that you will still be able to make this payment in the future. And if your collateral goes down, you basically you're forced to unwind your position, then the borrowing process will be terminated early. Maybe some of you have heard about this story. I think it was 2 years ago. There was a case in the US where people were short selling a stock called GameStop. Yeah. And then there were people colluding on Reddit and kind of trying to speculate against these short sellers. So they basically used this mechanism that I just described, because they were kind of, lots of people were buying the shares, the share price went up, right? So that means that the price that the short sellers would have to pay goes up, right? And suddenly the collateral of the short seller was not enough, and they were forced to unwind the position. But what does unwinding the position mean is, unwinding means they have to go to the market and buy the shares as well, right? And what happened was the share price went up even further. And this triggered even more hedge funds, who were short sellers, that they had to buy back the shares, right? So they triggered kind of this the spiral of events, and it was a very clever trade, to be honest, by these people on Reddit. It was very risky at the end because you didn't know how long this was going, right? It was definitely not something that was, kind of the share price was not supposed to stay out there forever, right? So you have to kind of time this very well when you want to exit your own position. But it was a very smart move to kind of understand the mechanism behind it and to abuse it and speculate against the big guys.